All right, good morning, everybody. It's CPI day, and that means we have the opportunity for the gap close play. Now, I don't know if we're going to get it, but whenever we have this opportunity, I like to point it out, even for those who don't necessarily want to trade the pattern, because at the very least, it might influence your bias on the day, and you won't try to go short, for an example, if we get a CPI print that looks like that. So the idea is at 8:30, we're going to get data, and we have the potential to have one of these kind of candles. This is a liquidity gap, not a price gap. So at 8:30, when the candle opens, that's the spot we have to go back to. These kind of patterns can happen in the intraday too, but this is like knowing where the lightning is going to strike, right? When we get these in the middle of the day, we never know we're going to get them until it happens. You can call it unfinished business, liquidity gap. I've heard them called God candles before. They have a lot of different names. The idea is we want no wick on the backside, and we want it to close near the other end. So we don't want it to close near the half. We definitely don't want it to close where it started. And if you break the candle into 4 parts, if this is 25 and then 50, and then 75, and then the last one is your fourth quarter 100, then we want it to stay in this quarter range. In this example, we got back there about 11 o'clock. 10:30, 11, those are good time frames. Now, I like to trade this pattern, but it doesn't have to be traded. You can just use it, as I mentioned earlier, as your bias. If we get an up print, then the idea is that's as high as we're going to go, very likely, on the day. If we get a down print, that's as low as we're going to go, likely, on the day, if we're going to go and close the gap. It's not guaranteed that we will close the gap. I've seen it where we get this candle, and then we continue moving in the same direction as that candle. So there's no guarantees. You can also use these candles and lay out levels from it. There's a midpoint to this candle, which I don't have it marked here, but if you think about the midpoint, that's what we ran up and hit right before the open. So even if it's a candle that we don't want, say a really big candle with wicks on each side, then you can measure that candle out, mark its midpoint, and mark projections away from it of 50% higher and 50% lower. Here's another example, CPI day. You can see how we closed in the upper portion of the first candle. The next one stayed within that wick zone, and then we continued the drive, finally topped out, and then we worked our way back down, got the gap closed before 11 o'clock. Here's another example, almost no wick, right? This is one of the conditions. We closed near the other end. We really didn't build much of a base up here. We just started moving back in the other direction almost immediately. Look how it responded near the midpoint. If we were to have marked the center of that candle, we started to build some structure there. Got the gap closed after 10:30. Now, this is an example of what we do not want to see, right? It doesn't mean that this candle isn't useful. We're just not going to use it for a gap close play. So we could take this candle's measurement and plot it to the upside 50%. And of course, we can plot it to the downside because we don't know which way price is going to go after this candle closes, right? We could have gone down, we could have gone up. So the height of that candle is an area where we struggled to get through. And then once we did get through the top of that candle, we stopped near the midpoint. I don't have it marked, but I would say we very likely topped out near the midpoint or the 50% mark of that measured candle. So here's non-farm payrolls, February 9th. This is an example of what we do not want. You can see how it closed near the 50% mark. We would have wanted it to close near the top. You can also see there was a lot of wick on the bottom. It's another reason that we would not have wanted to trade this. Now, it got the gap closed even before the open. So in less than an hour, we ran back down and we closed that gap. Me personally, this is not what I want, but it does show the gap got closed, right? So, I mean, if that's the goal, then great. But here's an example of the midpoint. Measured from the top to the bottom, we had the mid price responded there. It's also a cog line, 5032. So we had multiple reasons to believe that price would respond at that level. That's a tradable opportunity. Then once we did break through the candle to the upside, we stalled out at OCC, opposite candle color. What did we get when we got there? We got the opposite candle color. That's why I name it that. So these candles, even if they're not the trade itself, they'll be able to provide some insight on the rest of the trading day. Here's another example, June CPI. I think this is June 2023, but don't quote me on that. It could be 2022 for all we know. Still, it's another example. And if we measured it and plotted 50% to the upside, it's pretty sure that's where we topped out. And you can see the 1, 2, 3 fail pattern line up really nice here. Also a flat top wedge that broke down. All patterns based off of that first bar, that 830 print. Another example of what we don't want. And again, if we were to measure this and plot it to the downside 50%, it's where we stalled out on the day. Now, I mentioned that these can be used in the intraday. This was one that happened at 10 a.m. So it was one of those economic events that we get at 10 o'clock. We got the big push that created the gap. We actually had another event happen at 12:30. So we gapped again, closed that gap. At 3 o'clock, we got another event, which dropped us down, closed the first one, and then we ran back up and closed the last one before the end of the day. Wild, right? And that's a lot of gaps. So these can happen anywhere. But today, we have an opportunity for it to happen at 8:30. Markets are waiting on this data. I was actually trying to bring in spot gamma's, what they call the hero tool this morning. It's something that we can point at the futures even this early in the day. And I don't normally bring it in, right? This is something I'm trying to add to event days like CPI days, because I've already got a way to find their hedging. We're going to get to that in a minute. But if we can find other sources of hedging or other signals of hedging, then we want to add that to what we use, right? The tools in our toolbox. So in blue is puts, in orange is calls, and we can see the big move started just after 7 o'clock at dump down. We'll see. I'm going to slowly start adding in more and more of this when we can spot things that line up with our event days like CPI, PPI, non-farm payrolls, that sort of stuff. Yesterday's move to the downside lined up really well with Friday's low. And then we overshot, started to come back in again. That's still the level that I'm using for today. Friday's to Sunday night, Monday morning's high. So Friday's low, Monday's high. That range still in focus. So markets are waiting. We've got small caps down about 0.25%. Everything else is closer to zero. And Japan is up this morning, a little bit of a rebound back in the other direction, but still only 0.25%. Everybody's waiting on this data. As you can see, we got a lot of events at 8:30, and then 9:30, 9:45, 1, 1:30, 2 o'clock. It's going to be one of those days where it's just coming at us all day long. It's worth noting this very large discrepancy down here. We're looking at minus 67 billion versus minus 243 billion. So keep your eye on what's happening today at 2 o'clock, because this number is outrageous, right? The forecast doesn't look good. If the data today doesn't come in that bad, say it comes in even half of that, I think the markets are going to react to it. All right, well, they got it shown here as a medium on the event impact probability, but I would watch the clock. Keep your eye on it. Got a lot of Fed speakers. Yesterday, we had the Fed chipping teeth, and the market responded a little bit, not too much. I mean, they're beating the same drum, right? And they're all singing from the same hymn book. It's the same old dance. Still, there's always the potential for one of these guys to say something out of turn, to be taken out of context, inadvertently put their foot in their mouth. Things can go wrong. So if you have a Fed member speaking, you want to be wary and cautious. Shouldn't have anything in the overnight of interest until tomorrow morning. So nothing really out of Japan tonight of interest after this bond investment, which is still early enough in the night, right? Usually it's like 11:30, 1 o'clock when we start getting the big stuff out of Japan. That's worth keeping our eye on right there. Back into 155 area and causing them to perhaps react. All right, so ADR levels, they're not really going to do us much good until after we're done with CPI. We do have 59.82 to the downside and 60.42 to the upside, which is on the downside, it's below the level that we have marked, but on the upside, it's still within the range. I know that there's a lot on the screen, so if I just do this, it makes it easier to see the level. This is the box that we need to get out of. We know that CPI day, CPI, PPI, non-farm payrolls is a day where we have that opportunity to see hedging activity with the market maker move. And we're not seeing that yet. That's one of the reasons that I showed that picture of spot gamma, because we're not seeing the hedging activity that we would expect to see. Looking at the central pivot range on the daily range, it's a very narrow channel this morning. Now, this isn't as narrow as it could be. It can be so narrow you don't even see a channel at all. You just see the floor pivot. And it isn't that narrow because, well, we can see the channel. It's at 60.11. That's a cog line. So it makes that floor pivot even more valuable today. I already pay attention to the floor pivot because it has value. We can see that was where Monday reacted. Paying attention to where the floor pivot is just gives us context and insight on where the market is today. Are we above it, below it, bullish, bearish? These ranges, the channel on the pivot gives us some bias on what kind of day could we have? Are we expected to break out or break down? And if we do, is it expected to grow legs and really run or just come back inside the range? When the channel is really wide, the expectation is that if we do break out, we're likely going to just come right back in again. When it's a very narrow channel, it implies if we break out, we could grow legs and really run. And this is a narrow channel. The channel is lower than yesterday. That's considered bearish. We opened up underneath it, above it. So that's considered bullish. Those two cancel each other out. It doesn't take much to kind of assume that we're in a negative environment when we've had days of decline and we've had a lot of violence and volatility in those declines, and we're still down this morning. So not a whole lot of insight at that point. But that narrow channel does imply if we get a breakdown that we could really expand. To get a breakout, we would have to run all the way back up to Monday's high and then break out. Getting above yesterday's high is just one step, right? That wouldn't get us that breakout that we're looking for. But it's all one level at a time, right? So first, we need to get through the range that was built in the overnight. That's not even our full Globex. That's just the range of concern in the overnight. Then we have to get through yesterday's high. Then we have to get through Monday's high. Then we could really expand. Then that's a lot of work right there. You're looking at nearly 50 points, 55 points just to get that far. Now you're out of the house and ready to run. To the downside, all we really got to do is get through that 59.92 cog line and begin to expand to the downside. My breakdown target is still the same. It's this weekly pivot point, 59.29. So the last hurrah, if we break Friday's low, then it's game on. And I'm going to focus on this floor pivot. I don't expect the profile to really offer us much this morning. Pivots and structure, measured moves, and all of that, they take a back seat when we have something like CPI, PPI, non-farm payrolls. The flow from the algos and everybody that's trading around that event is going to be way more powerful than any of the pivots and levels that we could look at, including volume profile and value area high, value area low. We still have the same high volume node from last week that we've been focused on. If that breaks, then we're going to focus on this really shallow area. Price generally can move through a shallow area really fast. So the likelihood is if we break this high value node, high volume node up here, which is really lined up on that value area high line right there, we get underneath that, then we can likely retrace that move just as quickly as we ran through it the first time. To the upside, our week's pivot point, 60.24, and we've been crisscrossing back and forth through that thing. It doesn't have any context of support or resistance while we're hovering around it, right? So the whole time that we've been cutting back and forth through there, it doesn't have any value from the perspective of support or resistance. But now that we've left the range, if we attempt to come back up into this, I would expect it to act as a form of resistance. So we'd want to see a lot of trading activity at this level. The reason I say that is the point of control. The point of control is where there was the greatest amount of trading activity that's taken place since this week began. It doesn't take much to stretch the imagination and consider if that's where the greatest amount of trading took place and we go back to that spot, there's going to be some trader's remorse, some unfinished business. It's very likely we're going to see more trading activity at that level. Now, it doesn't line up perfectly with Friday's close. Friday's close is just underneath that level. But it was a level that we were focused on getting that gap closed when we opened Sunday night way up here, and then we started higher before we came down and got into that. It should be on your radar if we make a move to the upside, Friday's close, and then of course if we get through Friday's close, then the week's point of control. Before I move the screen, the put wall is all the way down here, 55.32 cog line. 55.32, that's a long ways off. We don't have any threat of that put wall at this point. And the markets apparently don't have any threat to what comes next, right? If they were concerned or worried or was getting ready to make some moves to the downside, they would roll that put wall up. That's my opinion. And we're not seeing that activity. On the other hand, we got OPEX this week. So, you know, if they're planning on maybe trashing the market next week, well, they don't need to roll it because they can just wait for everything to expire and kick off the new week bearish. So maybe that's why it hasn't rolled up. Either way, keep your eye on those options that are in that area. You can actually set them into a watch list and then look for trading activity on those. Otherwise, a break to the downside will take us farther away from the call wall into the ADR, the 3-week moving average, the full ADR, 10-day moving average, volatility trigger, 0 gamma, 20-day moving average, and then on down to 58.32 cog line and the 10-week moving average. We are a long ways away from the 10-week moving average. I don't have any expectation that we're going to get so negative today that we would move all the way down to 58.34. That's a long ways off, right? Now, don't get me wrong, we can make that move. I just don't see any reason that we would make that move. Not today. A move back up has to be taken into context of that put wall, that call wall. They didn't move it when we got through it before. It's very likely they're not going to move it again. And they're likely to take more opportunity to close out whatever's still up there. And there is something still up there, or the call wall wouldn't be there anymore, right? This level gets updated daily. And, you know, now that I'm looking at it, I updated my other Thinkorswim. I didn't update this one. Just a second. That might change everything. Nope, it's still there. The level gets updated daily. If the calls had been rolled or moved, then the call wall wouldn't be there anymore. It's still there. So you can add those options to your watch list as well. You can watch both walls to see if they're getting rolled or moved or getting activity. But since it's OPEX week, I wouldn't expect them to get that sort of activity yet. Maybe Thursday afternoon into Friday, they may roll them depending on where we're at. So it just doesn't hurt to keep your eye on those levels. 10-day, 30-minute volume profile, that shallow area that we were looking at on the weekly profile is really clearly seen here. The point of control was down here yesterday, and I had talked about how it's likely going to move up. Well, it's moved up. We're not going to lose this volume down here today. It's likely tomorrow afternoon and into Friday and then Monday of next week. But we are already holding that point of control up here. So that's not going to get taken away from us anytime soon. What we are going to be looking for is for this entire thing to get more narrow. We've got 60-60 on the upside and 57-20 on the downside. It's a really wide range. we're looking for this range to get more narrow, and to do that, days need to go by. We need to get through Wednesday and through Thursday, and then we'll start taking these candles off the board Friday. Now, once we get into next Wednesday, we will lose all of the bottom of this, and it'll start to constrict like this, and it'll get more and more narrow. The only thing that's going to stop it from doing that is A, if price comes back down, or B, if we expand to the upside, because then it would look more like that, and there would be price up here. But if we break this low, this 6,000 level, you can see how there's really not a lot of help here. And we moved through it really fast one direction. We're likely to move through it really fast the other direction. This is considered an air pocket of risk. There are things that we could hit, right? It's not like we're going to free fall. There's halfback levels, moving averages, points of control for previous days, higher time frame moving averages, and then things like weekly levels and monthly levels. There's things that we could hit. Looking at the 5x5 chart, we've got a really tight structure down here. Nothing in today's session really highlights anything of note. We didn't hit. Why, that level is way off. Maybe I grabbed it and moved it, right? Maybe. I don't think so, but all right. There's the point of control for yesterday. 60.15. I think that's off. That looks better. 60.16. So a move to the upside today has to get through that as well. And if we get near it, it'll begin to act like a magnet. We'll gravitate towards it. Looking at the weekly expected move, we're still kind of holding around the midpoint. The midpoint is Friday's close. This is the box that we need to get out of that we've been talking about, right? So whether we use Friday's candle with Monday's high, or if we use Tuesday's low and Monday's high, either way, it gets the job done. That's the range. That's what we got to get out of. If we can get out of this range, the target is the green line up above, 6,100, or the red line down below, 59.50. That's the week's range anyways, right? That's what we're expected to do for the week. Those will make really good targets for butterflies, or if you want to take long verticals. And by long verticals, I mean buy to open verticals, not go long the market, right? So you could buy a put spread if you want to go to the short side and build the puts at that level. That would just make them really cheap out of the money put vertical, or buy a call vertical. Use the strikes around that level, and it should be really cheap. Yeah, we're looking at the ES, but you could do the same thing for the SPY, SPX, XSP, any of those three, right? Of course, you could use the ES too, but pick your poison. Looking at the 10-week, we're still 2.87% away, and we are on the decline back down away from that 4% level. Nothing in here at this point is a danger. This is not overbought. We're not at risk. We're not overextended. It doesn't owe us any mean reversion or pullback, least squared methods, nothing. This is just a good, healthy spot to be. So from the 10-week, we're good. Look at the 10-day, we did need a little bit of a correction, and we can get a correction through time and price. So once we got more than 2% away, wow, I just seen a lot of dark pool prints come in. Once we got 2% away from the 10-day, we kind of stalled out there and we've started to get the correction. Notice how extreme or how fast we've moved back towards the 10. But if you look at price, we really haven't gone anywhere. That's a correction in time. We got there, we stalled out, we've been patiently waiting, and the 10 has been coming closer and closer to us. Sure, we went down a little, right? We're below Friday's close, so we did move towards the 10, but it moved towards us more than we moved towards it, right? So collaboratively, between it moving up and us moving down, we got back towards the 10 really fast, and it didn't take very much. So now we're at 0.87%. That's a good sweet spot. That's a good, healthy place to be. We're riding above that 10, and we're not extreme. We're not overbought, overextended, anything like that. We now have two sectors that are in the red over a 5-day period, and it's likely that we're going to get 2, maybe 3 more today. We can see that financials are almost flat now. Same with industrials and XLE energy. Now, we don't know for sure, right? They could find structure and begin moving back up, but all of these were up a lot earlier in the week. We can add, that'll be 1, 2, 3, 4, 5 out of 9 sectors that will all be in the red at this point. We're kind of due that anyways, right? Remember, we had moved really far, really fast in a lot of the marketplace. We need that pause and kind of some restructuring. Looking at what's left, tech still looks good at 1.2. Consumer discretionary, the frivolous spending still looks good at 3.4. Utilities, 1.2, and staples. That one, I believe, was red when we started the week, right? And it flipped the script. But Monday was a long time ago, so don't quote me on that. I'd have to go back and watch the morning briefing to be sure. Either way, it's green right now. So kind of keep your eye on those sectors through the day. See if the bleeding continues in financials, industrials, and energy. And we could look at what's up this morning, but really with CPI looming in 30 minutes, there's not a lot of edge in trying to really look at the names or the sectors that are up or down in the face of that. It's very likely that we're going to get CPI and the market's going to shake it off and we go from there. And remember, it's not just CPI today. We've got a lot of things on the calendar today. I know it doesn't look like much if we just come over and look at, say, Thinkorswim's document on the day, right? This is Wednesday for Thinkorswim, 8:30, 2 o'clock, and then tonight. But when we looked at all these other websites and we looked at the calendar here, for an example, on FX Street, we can see we've got a lot of Fed speakers on top of the economic data prints that we have today. So we got a lot of stuff today to deal with. Be careful, be safe, watch the clock. I'll see you all tomorrow.